McDonald's, Burger King. Flame broiled, fried. Hey everybody, Tom Gentile here. Glad to have you in for another video. Today, we're going to get past the preferential tastes of hamburgers and get into the financial tasting of these two companies. All right, we'll take a look at each, compare and contrast, conclusion, and we're also going to compare buying a stock versus buying options on one of these companies. So let's get going. So let's start with McDonald's. McDonald's, a whale of a fast food chain, not only here in the U.S., but across the globe. Last quarter, they had $5.35 billion in revenue. Their earnings were $1.57 billion, up 11%, so double-digit growth in the fast food restaurant McDonald's. Another thing I like about this company is it is recession-resistant. It's a cheap alternative to going out and dining, all right? It works for everyone, almost everyone. But their company's ability to adapt to situations like COVID-19 really make it a recession-resistant stock. And then finally, hedge funds. All right, so in 2019, hedge funds were already picking up McDonald's and adding it to their portfolio, and there were 15% more hedge funds going into the stock than coming out. And I imagine that's got to be even much more so as we go into 2020. Let's take a look at the financial or the technical aspect of McDonald's. So for here, we see MCD trading around just south of 220. This was before COVID-19. Once we came into that quick recession pullback, we dropped all the way down to $125 a share before rebounding to current levels, get this, $185. What a great rebound here for McDonald's. So when I take a look at this one, I can see that, the highs, about 220, just a little south of 220. The low was all the way down here at 125. We are much, much higher to the all-time highs of McDonald's than we are the lows that dropped in. So McDonald's has rebounded as a company much better than, let's say, the S&P 500 or the overall stock market. So it's actually been a silver lining to have a restaurant like McDonald's in your portfolio. Now let's take a look at Burger King. Many of you don't know that Burger King is not a publicly traded company, but in fact is a company that it has a parent company of restaurants called Restaurant Brands. The symbol is QSR. Restaurant Brands International had $1.48 billion in rev last quarter and about $165 million in earnings. Now, they have a little risk when comparing them to McDonald's. The risk is this. It's not Burger King that has the risks. It's everyone else under the Restaurant Brands International name. Because what we don't know is how they were affected. How much of their business is dine-in versus delivery. All right, and although Burger King is able to adapt just like McDonald's, what they can't count on is their brothers and sisters as part of Restaurant Brands International being able to do the exact same thing. Now, one of the pros that Burger King has for it, I'll give them the win for this. They were attacking during COVID-19. They were attacking in traditional ads with the couch potato ad. They were attacking on social media. I saw much more branding, much more being out there in social media like Twitter than I did with McDonald's as COVID-19 came to light. All right. So technically, let's take a look at Burger King, QSR. And you can see that QSR was trading in the high 60s prior to the drop of COVID-19. The drop came in, and this stock came down to around $25 a share before rebounding back to its current levels of about 48. So let's put it in the range, all right? 67, 48, 25, right? So it too is closer to its top number than it is its bottom number from February to March to the rebound we see currently as we head into the end of April. Now, Burger King or McDonald's? Which one makes more sense? Let's compare the two. Now, when you take a look at these in terms of the fundamentals, I think McDonald's is a clear winner here. They are a bigger brand, all All right, they're much more global. They have much better global presence. Their revenues and their earnings just kick Burger King right up to you-know-what. They're grilling it, guys, at McDonald's. And the thing is that not only their rev and earnings look good, but their growth is double digits where QSR is not. All right? Technically, it's a draw. When you take a look at those two charts, both McDonald's and Burger King, what you're going to find is from their pre-COVID-19 highs to the March lows to the April rebound, you're going to see that the percentages are very, very similar in percentage drop to percentage rebound. So technically, it's a draw. As far as options, this option trader wants to look at McDonald's, and the reason why I like McDonald's is because something called implied volatility on McDonald's is actually lower than QSR. All right? Does that mean the options are actually a little bit cheaper at McDonald's than Burger King? Yes, they are. Not cheaper in price, but cheaper in volatility, which means it's a percentage of the stock price itself. And because of that, we're going to look at McDonald's as a comparison between buying the stock and renting the stock using options. Let's take a look at McDonald's. Now, how do you trade this if you like this? First of all, I like it as a longer-term company. This is not something I want to trade into earnings because these companies as a whole have done so well on the way up. You know their earnings are going to be soft. In fact, I expect the earnings to come out of McDonald's on Thursday, April 30th after it close, to be on the soft side. Their projections are 155 to 159. I'm thinking we're going to be somewhere around the 155 area. All right, so I'm not thinking about this as a one-week trade. I'm thinking about this as a trade we could take into next year, into 2020. So we could buy the stock. Stock's going to cost us $18,500 for 100 shares. Or we could take an option trade. And I have looked at option trades in McDonald's that go out into January 2021 that, if positioned right, could lever 100 shares of stock, not for $18,500, but for the low, low price of $500. Or 500 value meals from McDonald's. Shall we continue? Let's. All right, so this particular graph you see here is if you were to buy 100 shares of stock, and it's at $185.89, but let's just call it $185 for purposes today. It's going to cost you $18,500. Now, we know we have risk that goes all the way down to zero, and the cost and the risk are $18,500. The chances of McDonald's going to zero are very, very close to zero. But the chances of it going down off the graph are quite high, as well as going up. We could go up to as high as $200. Now, that might be my target, but we could as easily go down to $170. If we go up to 200, we have a 15-point move. That's $1,500 in profit on a stock that cost us $18,500. However, if we go down to 170, that means we could have a loss of $1,500 on the exact opposite move. Okay? Now, let's look at this in terms of options. An option trade that I'm looking at right now involves the January 15th, 2021 leaps. A leap option is a long-term equity anticipation. It basically means an option that is longer term, that's 9 months or more. So if you take a look at this option, we're looking at the Jan 15, 190, 200 call spread. That means we're going to buy the 190 calls and sell the 200 calls. This right now is costing around $500 to do the spread together. Okay? We have, by buying the 190s, this is where we are in a position where we can exercise this and acquire the stock at 190. By selling the 200s, we're obligated to sell at 200. So I would love to do nothing all day long, but have the ability to buy McDonald's at 190 and be forced to sell it at 200. That's a 10-point move. If I pay 5 points for a 10-point spread, I have the ability to create a 100% profit. In order for that to occur, McDonald's has to be at or above 200 by January 15th, 2021. So, we took a look at McDonald's, we took a look at Burger King, we contrasted, we compared, and then I took McDonald's and compared buying 100 shares of stock to buying what's called a bull call spread, buying the lower strike, selling the higher strike. And you can see clearly that we have the ability to rent this stock for the rest of this year and into 2021 for a fraction of what it costs to buy the stock on its own. This is Tom Gentile. I want to thank you for joining me today. And again, if you like these videos, hit the like button there. That's that thumbs up. Also, if you want to get them on a timely basis, subscribe to my channel and you'll get these as soon as they're made available. Have a great day. We'll see you soon. Bye now.